Hello, everybody. In this moment, we are talking about corporate finance. Corporate finance deals with the capital structure of a corporation, including its funding and the action that management takes to increase the value of the company. Corporate finance also includes the tools and analysis utilized to prioritize and distribute financial resources. The ultimate purpose of corporate finance is to maximize the value of a business through planning and implementation of resources while balancing risk and profitability. And the important activities that govern corporate finance are first, investments and capital budgeting. Investing and capital budgeting includes planning where to place the company's long-term capital assets in order to generate the highest risk-adjusted returns. This mainly consists of deciding whether or not to pursue an investment opportunity and is accomplished through extensive financial analysis. By using financial accounting tools, a company identifies capital expenditures, estimates cash flows from proposed capital projects, compares planned investment with projected income, and decides which projects to include in the capital budget. Financial modeling is used to estimate the economic impact of an investment opportunity and compare alternative projects. An analyst will often use the internal rate of return or IRR in conjunction with net present value or NPV to compare projects and pick the optimal one. Second, dividends and return of capital. This activity requires corporate managers to decide whether to retain a business's excess earnings for future investments and operational requirement, or to distribute the earnings to shareholders in the form of dividends on share buybacks. Retained earnings that are not distributed back to shareholders may be used to fund a business expansion. This can often be the best source of funds, as it does not incur additional debts nor dilute the value of equity by issuing more shares. At the end of the day, if corporate managers believe that they can earn a rate of return on a capital investments that's greater than the company's cost of capital, they should pursue it. Otherwise, they should return excess capital to shareholders via dividends or share buyback. And third, capital financing. This core activity includes decisions on how to optimally finance the capital investment through the business equity, debt, or a mix of both. Long-term funding for major capital expenditures or investment may be obtained from selling company stocks or issuing debt securities in the market through investment banks. Balancing the two sources of funding should be closely managed because having too much debt may increase the risk of default in repayment, while depending too heavily on equity may dilute earnings and value for original investors. Ultimately, it's the job of corporate finance professionals to optimize the company's capital structure by lowering its weighted average cost of capital or WACC as much as possible. And then, how important is a company's capital structure in corporate finance? A company's capital structure is crucial to maximizing the value of the business. Its structure can be a combination of long-term and short-term debt and or common and preferred equity. The ratio between a firm's liability and its equity is often the basis for determining how well balanced or risky the company's capital financing is. A company that is heavily funded by debt is considered to have a more aggressive capital structure and therefore potentially holds more risk for stakeholders. However, taking this risk is often the primary reason for a company's growth and success. And then the role of corporate finance. We know corporate finance is pivotal in managing financial activities that drive success in every enterprise. It is like the financial engine that powers business decisions. There are, firstly, corporate finance secures funds for operations and growth. It evaluates whether to raise money through loans or by selling ownership stocks. Secondly, it quite investment analyzing is very important. The guides investment analyzing potential projects to ensure they yield profitable returns. And then 3, moreover, it manages risk by identifying potential pitfalls and creating strategies to mitigate them. Just as insurance protects us, corporate finance safeguards the business's financial health. 4. It helps make financing decisions easier, for instance, understanding the best mix of debt and equity to fund business operations and expansion and optimizing financial structure. 5. It oversees cash flow to ensure there is enough to cover expenses and investment. And lastly, corporate finance monitors performance, comparing actual outcomes with projections and making necessary adjustments. And the fundamental concepts in corporate finance are: first, time value of money. The time value of money is a core principle in corporate finance. It recognizes money's changing worth over time. Just as prices rise with inflation, money today is generally worth more than the same amount in the future. Second, cost of capital. The cost of capital is the required return a company must earn on its investments to satisfy its investors. It comprises the cost of equity and the cost of debt. And third, cash flows. Cash flows are the monetary movements into and out of business. Positive cash flows signify healthy operations, while negative cash flows can raise concerns. In corporate finance, cash flows are vital for assessing a project profitability. I think it is enough for this session, and thank you for your attention, and don't forget to give this channel a like, comment, subscribe, and don't forget share. Thank you.